Our next guest expects a sideways trading range for the next 10 years, and he calls it a trader's dream. Let's bring in Barry Bannister, Stifel Chief Equity Strategist. Barry, great to have you with us. It's hard enough to call a year, but you're calling a decade, and you're calling it flat. Why are you doing that?
We've been talking about this since 2019. You know, the market peaked a couple days into about mid-March of 2020 with COVID. We've made progress since then, and we came right back down and then back up on a bounce. I think it's easier to focus on the current year, which a lot of our research does, and then also on the long term, 5 to 10 years out, and leave the middle to just be worked out. When you look at it, the price earnings multiple from December 2021 is going to come down by about half. The earnings should just about more than double. And so you'll end up with a flat market, much like 2000 to 2013 or 1969 to 1982 or 1937 to 1946. I mean, I can go back quite a long time. You end up with these flat, sideways, range-bound markets.
So, Barry, when you look at it, though, there's so many geopolitical possibilities that used to be outliers. They're not outliers anymore. There's so much happening inside this country. So I get that in 10 years, it could be sideways. Do you see major events happening short term?
Yeah, back in October of 2022, just about a week and a half after the lows, we said that we would be up 500 points by April, and about 85% of that move is done. So the easy money is behind us. The hard money is now. We've been saying that there's going to have to be avoidance of a recession, and that would have to be pushed back. And it looks like that is pushed back, but a classical recession by the end of the year is possible. And as far as longer term, yeah, the geopolitical risk surrounding oil, which is really the key to inflation as much as labor, that is a very big issue long term. The dollar over the very long term is going to be, as a store of value, is going to be under some pressure. And we've got this thing called fiscal dominance, where the Fed loses relative power to the big spending treasury, and eventually, you know, the populists vote for their own benefits, and that has to be funded with debt. It makes it a lot harder for interest rates to stay very low, and that's what stocks need to stay very high.
Barry, this is Bono, and thanks so much for your time. So reading your report, it would seem to imply that being that we're going to be flat, or it's reported that we're going to be flat over the next decade or so, the buy and hold low fee index strategy likely is not going to perform well. So it sounds like, one, you'd be a proponent of active management during this period of time. My question is, what type of strategies do you think perform best in the environment that you foresee over the next decade?
Yeah, well, we definitely know how these environments shake out. They tend to be slightly more inflationary. They tend to feature a weaker dollar. They tend to have a compression of PE ratios. The price earnings multiple comes down. So those would argue for international value, small cap as an overweight, and growth over the long term as an underweight in your portfolio. So we all know what value is. That's everything from these beaten up banks to energy when it resurges, to industrials and basic materials. And we know what small cap is. And the international, it could be a mix of Europe and emerging markets.
Barry, great to get your thoughts. Thank you.
Thank you.
Barry Bannister, Stifel.
All right. So long-term outlook, and all the power to them. It makes sense in many ways. I would just say this: if I'm looking at small caps, which you mentioned a couple times that you want to be overweight in that environment, I do not think you want to be overweight small caps right here. So I saw David Rosenberg mention this morning there's a death cross happening in the Russell 2000. If you look at the underperformance relative to the S&P 500 and the NASDAQ, it just really feels like it wants to crack here. And all the things that we talked about at the top of the show, which, well, listen, we know there's a lot of like small cap financials that are in this index or whatever, but if you go back to November 8th of 2021, that's when the Russell 2000 topped out, and that was a month before basically the NASDAQ did, and it was 2 months before the S&P 500 did. So I'd keep a close eye on the Russell here. I really think it could be a leading indicator for the larger cap indices.
So just, you know, the top 5 NASDAQ names are 45% of the NASDAQ. It's what I said before. That's just not going to happen. And international is going to continue to, I think, it finally relative underperformance for more than a decade. I mean, we've had this mean reversion. I think we've just started that.